something that's been top of mind for a lot of our clients recently. We've been getting a lot of questions about the labor market. And we've touched on the labor market high level as it relates to our investment framework, but thought we could go a little bit more in depth and specifically speak to, the overall tightness of the labor market, how the Fed is dealing with the tight labor market, and then ultimately what the consequences of a softening or loosening labor market are for the US economy. So we're going to dive right into it. We'll throw up the first chart and just give everyone a perspective, what we're talking about when we're talking about tightness of the labor market. So when you're looking at softness or tightness of the labor market, there are a number of different metrics to look at. One, of course, is the unemployment rate. The unemployment rate is very low, so that would imply a very tight labor market. A better metric with some data that's been circulating across academic circles recently to just sort of add some time series to this data is the number of unemployed persons per job opening. And that's this blue line here going all the way back to the 50s. And currently the situation is there's 6 million unemployed people in the country that are in the labor force, but over 11 million job openings. So if you put that into a ratio, that implies 0.54 unemployed persons per job opening. And by this metric, this is arguably the tightest labor market in post-war history. To be very specific, a couple months ago was the tightest labor market ever. We've seen slight softening or loosening here in the last few months. But another way to think about this is if every single unemployed person in the economy were to get a job, you would still have 5 million open job openings. So there's a massive shortage in terms of labor in the economy. So, how is the Fed thinking about this? Well, the Fed has a dual mandate, full employment. You would look at this and you'd say, well, they've done that. In fact, they've gone past full employment. We're to the point where there is a shortage of labor in the economy. And so this can become a problem because of the next part of the Fed's dual mandate, price stability. So now we can sort of talk about how these things interact, and this is where the Fed gets involved. So on the next slide here, we look at the relationship between labor market tightness and inflation, which speaks to the price stability side of the Fed's mandate. So what you'll see here is we're plotting quit rates. Quit rates there are shown in red. Quit rates are one of the best leading indicators as to the tightness of the labor market. If folks out in the economy are willing to quit their job and go find another job, and they can do that easily, so a high quit rate, that means this is sort of an employee's job market. It implies that there is a shortage of labor. Workers are in high demand. They can leave their job, go somewhere else, potentially get a pay increase. And that's exactly what has been happening. You see the red line has gone up close to 3%, near an all-time high quit rates. And we know a lot of this was brought on by the pandemic, but overall this has continued because it's been very easy to quit your job and go find another job and in a lot of instances get a raise, a pay increase, which is what we see in the blue line. So the blue line is wage growth year over year. This is tracked by the Atlanta Fed. And you can see these lines are pretty much related. So how you can kind of look at it is you take the current quit rate, and generally speaking, the historical relationship has been double that current quit rate, and you have a very good estimate of wage growth over the next 12 months. So if we were to do that math right now, that would imply something like 5 to 6% wage growth from here over the next 12 months based on the massive shortage of labor. And so this is where the Fed comes in, because now we're speaking to price stability, right? If you have 6%, 5 to 6% wage growth from here, given the amount of inflation we're already seeing in the economy, that is a serious issue for the Fed. That's a serious issue for price stability. And so now you can see both sides of the Fed's dual mandate are now becoming in conflict. Yes, they want full employment. It's great that everybody looking for a job could find one if they wanted, but now there's such a shortage of labor that it's threatening price stability. And you see everything we've heard out of the Fed since Jackson Hole and even before the Jackson Hole symposium at the end of August has talked about how the two sides of the mandate are in conflict. And so the question is, can the Fed do both? Can they keep full employment while restoring price stability, bringing down inflation? And increasingly, if we look at some of the sound bites from Jerome Powell from the most recent FOMC press conference last week, you see the Fed is now of the opinion that they cannot have both. They are going to have to compromise the labor market, experience some softening in the labor market in order to achieve price stability. And you see that basically the first half of this quote. Higher interest rates, slower growth, and softening labor market are all painful for the public, acknowledging this, but they are not as painful as failing to restore price stability. So now we've gotten to the point where the Fed is saying, all right, we've let this tight labor market go on for too long. We have to put a stop to this because now inflation is a bigger problem. So what are the economic consequences of this? We know that the U.S. economy is very sensitive to changes in the unemployment rate. Historically, an increase in the unemployment rate of 0.5% from the recent low, that amount of softening, which doesn't seem like a lot, but that has been enough to tip the U.S. economy into a recession historically. So we'll start to look at these variables together and see, can the Fed pull it off, a soft landing? Can the Fed pull off a soft landing? So if we look at the next chart, we look at the first relationship here. This is your classic Phillips curve relationship, which basically means if the Fed wants to decrease core inflation, how much can they reduce core inflation without tipping the economy into recession by increasing unemployment? So immediately getting up at this trade-off. So historically, if you look at the green bars, those have been the past reductions in year-over-year core inflation that the Fed has been able to manufacture. And the blue line is the corresponding increase in the unemployment rate, or the blue bars there, the grayish blue bars. And historically, the Fed right now they have to reduce core inflation by somewhere between 2 and 4%. On a year-over-year basis. If you look at core CPI, it's running in the 6s. If you look at core PCE, it's running in the mid-4s. They want to get those things something down like 2%. So they have to reduce inflation by 2 to 4%. Historically, if they want to reduce inflation by that magnitude, they've experienced an increase in the unemployment rate of upwards of 2%, far beyond the amount of unemployment associated with an economic recession. So if you look at what the Fed is saying they're going to accomplish this time around, hey, we're going to reduce inflation by 4%, but we only expect the unemployment rate to increase by 0.9%. That does not seem reasonable. That seems like a very low probability event, a very optimistic forecast. If you're going to decrease inflation by 2 to 4%, historically, that means you're going to increase unemployment by over 2%, and that's going to tip the economy into recession. So that's one way of looking at it. The Fed is in a very difficult situation. They're the two sides of their dual mandate. They are at odds with each other, and they basically have to choose, and they've chosen inflation. So another thing to look at would be a different relationship that the Fed monitors. This is called the Beveridge curve. And another thing that the Fed is saying they want to do is reduce job openings. There's this idea that the Fed can just reduce job openings because they're clearly excessive job openings, 11 million of them out there. Just reduce the job openings by tightening monetary policy, and hopefully no one has to lose their job. But if we look at this historical relationship, so on the vertical axis, you have the year-over-year change in the unemployment rate. And on the horizontal axis, you have the year-over-year change in job openings as a percentage of the labor force. And you can see where we've been recently. All of those green dots, what we've been experiencing here has been job openings have been going up by plus 2% year over year. One of the fastest increase in job openings we've ever seen. And those have been associated with a pretty significant reduction in the unemployment rate. Well, where we're at now on this graph, the bottom right quadrant, Fed is basically saying over the next 12 to 24 months, well, I want to go to the bottom left. I just want to decrease job openings by about 2%, but I don't experience any increase in unemployment. And that also is a historical, basically, impossibility. The reality is every decrease in job openings we've seen since the 1950s of this magnitude has been associated with a pretty significant increase in unemployment. So a reduction in job openings just back to pre-pandemic levels, historically, that would have resulted in something like a 4.5% increase in the unemployment rate. So, taking all this together, what the Fed's saying, the position they're in, it's a very difficult situation. In our view, any additional tightness in the labor market that we see, any additional strength in the labor market, which is, really the last area of the economy that's outperforming, it's just going to be met by more and more hawkish monetary policy, higher interest rates, because the Fed is actively trying to loosen and soften the labor market in order to bring inflation down. And it's very easy right now for the Fed to come out and say what they've said, that we are all about price stability. We are willing to tolerate a softening in the labor market. It's easy for them to say that right now because everybody has a job that wants one. It is going to be very interesting to see over the coming months when the labor market does finally start to soften. And as we get into next year and people are actually losing their jobs, will the Fed be saying the same thing? Will they be able to stand up there and say, hey, we understand Americans are losing their jobs, but we need to restore price stability. We're going to continue to hike interest rates or leave interest rates high. That will be a very difficult time for the Fed. And that will be something that we'll be watching very, very closely. So, that was sort of our deep dive. That's still, we have plenty more research around the labor market. This is still sort of scratching the surface. So if you want to get in touch with us and have a more in-depth conversation about the labor market and get more granular data, we are happy to do so. Thank you for watching, and please feel free to reach out.